Look, I need to be straight with you about something that's happening right now in the gold market. And I'm not talking about the usual price movements or technical analysis. I'm talking about a fundamental shift in how this entire game is being played, a shift that most people won't understand until it's too late. You see, for decades, the gold market has operated under a certain set of rules, rules that everyone understood, rules that made sense. But those rules, they're changing. And if you're stacking gold right now or thinking about it, you need to understand what's happening before you make your next move. Let me paint you a picture of what I'm seeing. Central banks around the world just bought 166 tons of gold in a single quarter. Now, you might hear that number and think, okay, that's a lot of gold. But here's what makes it significant. That's 41% higher than the historical quarterly average. These aren't small purchases. These aren't routine additions to reserves. This is aggressive accumulation. And it's not just the volume. It's who's buying and why they're buying that tells the real story. The BRICS nations have increased their gold reserves by 102%. Let that sink in for a moment. While Western central banks have been relatively stable in their holdings, the BRICS bloc has more than doubled their gold position. China, Russia, India, Brazil, South Africa, and now the expanded BRICS membership are fundamentally changing their relationship with gold. But why? Why this sudden urgency? Why this aggressive accumulation? The answer lies in something that's been quietly building for years but is now reaching a critical inflection point. It's called de-dollarization. And it's not a conspiracy theory. It's not speculation. It's happening right now, in real time, with real consequences for anyone holding dollars or dollar-denominated assets. Think about it from their perspective for a moment. If you're a central bank in a BRICS nation, you've watched what happened when Russia was cut off from the SWIFT payment system. You saw how quickly financial sanctions can be weaponized. You saw how a country's dollar reserves can become worthless overnight if the wrong political decision is made. That's a terrifying realization for any nation. Your entire reserve system, your financial security, your ability to conduct international trade, all of it dependent on the goodwill of another country's government. So what do? You diversify. You find alternatives. And the oldest, most proven alternative in human history is gold. But here's where it gets interesting. This isn't just about buying gold as a hedge. This is about building an entirely new financial architecture, one that doesn't depend on the dollar, one that can't be sanctioned or frozen or weaponized. There have been discussions about a BRICS currency backed by gold. Now, the recent summit didn't produce concrete results on a shared currency, but the fact that these conversations are happening at the highest levels of government tells you everything you need to know about where this is headed. Imagine a scenario where a significant portion of global trade is settled not in dollars, but in a gold-backed unit of account. What happens to dollar demand? What happens to the value of dollar-denominated assets? What happens to the purchasing power of your savings? These aren't hypothetical questions anymore. These are real scenarios that central banks are actively preparing for. And here's what most people miss. The gold market isn't big enough to absorb this kind of demand without massive price dislocations. Let me explain what I mean by that. The entire above-ground gold supply is estimated at around 200,000 tons. Sounds like a lot, right? But when you break down who owns what, the picture becomes much clearer. Central banks hold about 35,000 tons. Private investors hold maybe 40,000 tons. The rest is in jewelry, industrial applications, and other uses. Now, if central banks are buying 166 tons per quarter, that's over 650 tons per year. At current rates, they're absorbing a significant portion of annual mine production, which is only around 3,000 tons globally. But here's the kicker. Most of that mine production is already spoken for. It goes to jewelry manufacturers, industrial users, existing investment demand. The actual available supply for new buyers is much smaller than people realize. So when you have this massive institutional demand hitting a market with limited available supply, what happens? Basic economics tells you the price has to adjust, and it has to adjust significantly. But there's another layer to this that makes the situation even more interesting. The gold market operates on two levels, the physical market and the paper market. The physical market is actual gold bars, coins, bullion. The paper market is futures contracts, ETFs, derivatives, all the financial instruments that represent claims on gold but aren't actually gold. And here's the thing. The paper market is much, much larger than the physical market. Some estimates put the ratio at 100 to 1 or even higher. For every ounce of physical gold, there are 100 ounces worth of paper claims. This works fine as long as everyone's playing the same game. As long as most people are happy to trade paper claims and never actually demand physical delivery. But what happens when that changes? What happens when central banks start demanding physical delivery? What happens when large institutional buyers say, "We don't want your paper, we want the actual metal"? That's when you get what's called a squeeze, a supply squeeze, where the available physical supply can't meet the demand for delivery. And when that happens, the price has to rise to ration the available supply. We've seen hints of this already. There have been periods where premiums for physical gold over the paper price have spiked, where delivery delays have extended, where certain forms of gold have become difficult to source. These are warning signs. These are the market telling you that stress is building in the system. Now let me shift gears for a moment and talk about something that's relevant if you're thinking about your retirement security. If you're sitting on a substantial retirement account, maybe $100,000 or more, you might be wondering how to get exposure to physical gold within that account. I put together a free guide on how gold IRAs work. It covers the process of getting actual physical gold into your retirement account without triggering tax penalties. You can find it in the description if that's something you want to explore. Just wanted to mention that because it's relevant to this conversation. All right, back to what's happening in the market. Let's talk about what this means for price discovery, because this is where things get really interesting. For decades, gold prices have been set primarily in the paper markets, the COMEX in New York, the LBMA in London. These are where the price is discovered through futures trading and over-the-counter transactions. But what happens when the physical market starts to diverge from the paper market? What happens when buyers in Shanghai or Mumbai are willing to pay significantly more for physical gold than the paper price in New York? What happens when that premium becomes persistent rather than temporary? You get a breakdown in the traditional price discovery mechanism. You get a situation where the paper price no longer accurately reflects the true value of physical gold. And we're starting to see signs of this. The Shanghai Gold Exchange, which deals primarily in physical gold, has at times traded at significant premiums to the COMEX price. This isn't supposed to happen in an efficient market. The fact that it is happening tells you that something fundamental is changing. Now, let me take you back in history for a moment because understanding where we've been helps us understand where we're going. In 1971, President Nixon closed the gold window. He ended the convertibility of dollars into gold. This was supposed to be a temporary measure, but it became permanent, and it fundamentally changed the nature of money. Before 1971, the dollar was as good as gold because it was backed by gold. After 1971, the dollar was backed by nothing but faith in the U.S. government. It became a pure fiat currency. For a while, this worked. The dollar remained the world's reserve currency through sheer momentum and the strength of the U.S. economy. But over time, the consequences of unlimited money printing started to become apparent. Fast forward to 1980. Gold hit $850 an ounce. Adjusted for inflation, that's over $3,000 in today's dollars. Why did it spike so high? Because people lost faith in the dollar. Inflation was raging. The government was printing money to finance deficits. People fled to gold as a store of value. Then Paul Volcker came in as Fed chairman and jacked interest rates up to 20%. He broke the back of inflation, but he also broke the gold bull market. Gold entered a 20-year bear market. But here's what's different now. Back then, it was primarily Western investors buying gold. Now, it's central banks. It's entire nations. It's a much larger, much more sustained source of demand. In 2008, during the financial crisis, gold was around $800 an ounce. By 2011, it had more than doubled to over $1,900. Why? Because people saw the massive money printing, the bailouts, the quantitative easing, and they realized that the purchasing power of the dollar was being systematically destroyed. But then gold entered another correction. It fell back to around $1,050 by 2015. Many people thought the gold bull market was over. They thought the dollar would remain strong indefinitely. They were wrong. Since 2015, gold has been in a steady uptrend. It broke through $2,000, then $2,500. And the fundamentals supporting this move are stronger than they've ever been. Because this time, it's not just about inflation. It's not just about money printing. It's about a fundamental restructuring of the global monetary system. Let me explain what I mean by that. The dollar's role as the world's reserve currency has given the United States enormous advantages. It means we can run massive trade deficits and finance them by printing dollars. It means we can impose sanctions and cut countries off from the global financial system. It means we have what's called exorbitant privilege. But that privilege comes with responsibilities. And increasingly, the rest of the world feels like the U.S. is abusing that privilege, printing too much money, weaponizing the financial system, using the dollar as a tool of foreign policy rather than a neutral medium of exchange. So they're looking for alternatives. And gold is the most obvious alternative because it's the one asset that no government can print, no central bank can debase, no politician can manipulate. It's the ultimate neutral reserve asset. Now here's where this gets really interesting for you as an individual investor or someone stacking gold. If this trend continues, if de-dollarization accelerates, if more and more international trade is settled outside the dollar system, what happens to gold demand? It goes exponential. Because every central bank, every sovereign wealth fund, every major institution will need to hold more gold as a reserve asset, not as a small hedge, but as a core holding. Maybe 20, 30, 40% of reserves in gold instead of the current 10 to 15%. Do the math on that. If central banks globally need to double their gold holdings, that's another 35,000 tons of demand. At current production rates, that's more than a decade of total global mine production. Where does that gold come from? Who sells? And at what price? The only way to balance that equation is through much higher prices. Prices high enough to incentivize existing holders to sell. Prices high enough to ration the available supply. Some analysts are talking about gold at $5,000 an ounce. Some are talking about $10,000. Some are even talking about $20,000 or higher. Now, I'm not going to sit here and give you a specific price target because nobody knows exactly where this goes. But what I can tell you is that the fundamental drivers are in place for a sustained bull market in gold that could last for years. And here's the thing. Most people won't recognize this until it's already happened. They'll wait until gold is at $4,000 or $5,000 and then decide to buy. By then, they'll have missed the bulk of the move. The time to position yourself is when the fundamentals are changing, but the crowd hasn't caught on yet. And that's where we are right now. Let me give you another angle on this. Think about the industrial demand for gold. It's not just a monetary metal. It's used in electronics, in medical devices, in aerospace applications. As technology advances, industrial demand for gold is increasing. But here's the problem. If central banks are absorbing most of the available supply, where does industrial demand get met? Either prices have to rise to incentivize more production, or industrial users have to find substitutes. And finding substitutes for gold in high-tech applications isn't easy. Gold has unique properties. It doesn't corrode. It's an excellent conductor. It's malleable. There aren't many materials that can replace it in critical applications. So you have this situation where both monetary demand and industrial demand are increasing, hitting a market with relatively inelastic supply. That's a recipe for sustained price appreciation. Now, let's talk about the supply side for a moment. Gold mining is a difficult business. It takes years to bring a new mine into production. You have to find the deposit, get permits, build infrastructure, extract the ore, process it. The lead time from discovery to production can be a decade or more. And here's the thing. The easy gold has already been found. The low-hanging fruit has been picked. New discoveries are deeper, lower grade, more expensive to extract. The all-in sustaining cost for many gold miners is now over $1,200 an ounce. Some operations are even higher. What that means is that even if gold prices rise significantly, supply won't respond quickly. It takes time to bring new production online, and in the meantime, demand continues to grow. This is what creates a supply deficit, where demand exceeds supply for an extended period, and the only way to resolve that deficit is through higher prices. But there's another factor that most people don't consider: above-ground supply. Most of the gold ever mined still exists. It doesn't get consumed like oil or copper. It gets recycled, melted down, reformed. So in theory, there's a huge amount of gold that could come back onto the market if prices rise high enough. But here's the catch. Most of that gold is held by people who don't want to sell. It's in jewelry that has sentimental value. It's in central bank vaults where it's held as a strategic reserve. It's in the hands of long-term investors who understand its role as wealth preservation. So even though there's a lot of above-ground gold, the amount that's actually available for sale at current prices is much smaller than people think. This is what creates the potential for explosive price moves. When demand surges and available supply is limited, prices can gap higher very quickly. We saw this in the 1970s, we saw it in the 2000s, and we're likely to see it again in the coming years. Now let me address something that skeptics often bring up. But gold doesn't pay interest. It doesn't generate cash flow. Why would you hold it? This is a fair question, and it deserves a thoughtful answer. Gold is not an investment in the traditional sense. It's not a business that generates profits. It's not a bond that pays coupons. It's a store of value. It's insurance against monetary instability. When you buy gold, you're not betting that it will generate returns. You're betting that it will preserve your purchasing power when other assets fail to do so. Think about it this way. If you have $100,000 in cash and inflation runs at 7% per year, you're losing $7,000 in purchasing power every year. That's a guaranteed loss. Gold doesn't have to do anything except maintain its value relative to goods and services to beat that. And historically, over long periods, gold has done exactly that. It has maintained its purchasing power across centuries, across different monetary systems, across different political regimes. An ounce of gold could buy a fine suit in Roman times. It can buy a fine suit today. That's the definition of a store of value. But here's where it gets interesting. During periods of monetary instability, gold doesn't just preserve purchasing power. It increases purchasing power. It outperforms other assets because people flee to safety. And we're entering a period of monetary instability. The debt levels are unsustainable. The money printing is accelerating. The geopolitical tensions are rising. All of these factors favor gold. Let me give you a specific example of how this plays out. Imagine you're a retiree with a $500,000 portfolio. You have it invested in a mix of stocks and bonds. The stock market is at all-time highs. Bonds are paying low yields. You're comfortable, but you're also aware that valuations are stretched. Then a crisis hits. Maybe it's a banking crisis. Maybe it's a geopolitical event. Maybe it's a debt crisis. Whatever it is, markets panic. Stocks drop 30%. Your $500,000 is now $350,000. But if you had allocated even 20% to gold, that portion would likely have held its value, or even increased. Your $100,000 in gold might now be worth $120,000 or more. Your total portfolio would be $400,000 instead of $350,000. That $50,000 difference might not sound like much, but when you're living off that portfolio in retirement, it's the difference between maintaining your lifestyle and having to make painful cuts. This is why gold is often called portfolio insurance. It's not about maximizing returns. It's about protecting against catastrophic losses. And right now, with the changes happening in the global monetary system, the insurance value of gold is higher than it's been in decades. Let me bring this back to the central theme. The rules are changing. For decades, the gold market operated under a certain set of assumptions. The dollar was the undisputed reserve currency. Central banks were net sellers of gold. The paper market dominated price discovery. Physical demand was primarily from jewelry and small investors. Every single one of those assumptions is now being challenged. The dollar's reserve status is being questioned. Central banks are net buyers, not sellers. The physical market is asserting itself. Institutional demand is surging. This is a fundamental regime change, and regime changes create opportunities for those who recognize them early. Think about the people who bought real estate in 2010 after the housing crash. They recognized that the fundamentals had changed, that prices had overshot to the downside, that a new cycle was beginning. They made fortunes. Think about the people who bought tech stocks in the early 1990s. They recognized that the internet was going to change everything, that we were at the beginning of a new era. They made fortunes. We're at a similar inflection point with gold. The fundamentals are changing. The old rules no longer apply. A new cycle is beginning. The question is, will you recognize it in time? Because here's the thing about these regime changes. They're obvious in hindsight, but controversial in real time. When real estate was bottoming in 2010, most people were still scared of the housing market. When tech stocks were taking off in the 1990s, most people thought they were overvalued. Right now, with gold, most people are either ignoring it or skeptical of it. They see the price going up and they think it's a bubble. They don't understand the fundamental drivers. They don't see the regime change happening. But the smart money sees it. Central banks see it. Sovereign wealth funds see it. Large institutional investors see it. The question is, are you going to wait until everyone sees it? Or are you going to position yourself now while there's still time? Let me give you one more piece of the puzzle. The relationship between gold and real interest rates is one of the most reliable patterns in financial markets. When real interest rates are negative, meaning inflation is higher than nominal interest rates, gold tends to perform very well. When real interest rates are positive, gold tends to struggle. Right now, real interest rates are barely positive, and in many cases still negative when you account for true inflation. This is a favorable environment for gold. But here's what most people miss. Even if real interest rates rise, if the fundamental drivers I've been talking about continue, gold can still perform well. Because the demand from central banks and the de-dollarization trend are powerful enough to overcome the headwind of higher real rates. This is what makes the current setup so compelling. You have multiple drivers all pointing in the same direction: monetary instability, geopolitical tensions, de-dollarization, central bank buying, supply constraints, industrial demand. Any one of these factors alone would be bullish for gold. All of them together? That's a once-in-a-generation setup. Now, I want to be clear about something. I'm not saying gold only goes up from here in a straight line. There will be corrections. There will be periods of consolidation. There will be times when it feels like the bull market is over. But if the fundamental drivers remain in place, those corrections are buying opportunities, not reasons to sell. This is how bull markets work. They climb a wall of worry. They shake out weak hands. They make people doubt themselves. But the underlying trend remains intact. And the underlying trend in gold right now is one of the strongest I've seen in my career. So, what does this mean for you practically? If you're not holding any gold, consider starting a position. Even a small allocation can provide meaningful portfolio protection. If you're already holding gold, understand that this isn't the time to get shaken out by short-term volatility. The long-term picture is incredibly bullish. If you're thinking about adding to your position, focus on physical gold or vehicles that give you exposure to physical gold. Avoid the highly leveraged paper products that can blow up in volatile markets. And most importantly, understand that this isn't about getting rich quick. This is about preserving wealth in a changing monetary system. This is about positioning yourself for a multi-year trend that's just getting started. The rules have shifted. The game has changed. The question is, are you going to adapt, or are you going to stick with the old playbook and hope for the best? Because hope is not a strategy. Understanding the fundamentals, recognizing the regime change, and positioning yourself accordingly, that's a strategy. And right now, that strategy points toward gold.